Interest rates are supposed to be the price of money, determined by supply and demand, rising when capital is scarce and falling when it's abundant, rising when inflation threatens and falling when growth weakens. This is the story told in economics textbooks, the neutral technical explanation of how monetary policy works. But the actual history of interest rates over the past century reveals something more disturbing, which is that rates don't fluctuate around some natural equilibrium. They follow a pattern of long rises followed by catastrophic crashes. And these crashes aren't random market corrections. They're policy choices made in response to crises, and the crises themselves are often caused by the previous period of high rates, creating a cycle where tight money causes problems that can only be solved by loose money, which eventually causes different problems that lead to tight money again. And this cycle has repeated multiple times after World War I, after World War II, in the 1970s and 80s, and most recently after 2008, and each time the crash in rates, the move from restrictive to accommodative policy, comes not because the economy has naturally reached some equilibrium, but because something broke, because the previous level of rates caused a crisis that forced policy reversal. And understanding this pattern, understanding why interest rates always crash rather than gently declining, reveals fundamental instabilities in how we manage money and debt, reveals that the monetary system operates in a constant oscillation between extremes rather than finding stable middle ground, and suggests that the current era of near-zero rates, which has persisted since 2008 with only brief interruptions, is not an aberration but a predictable consequence of how the system works, and that the next cycle, whenever it comes, will likely follow the same pattern of rise and crash rather than smooth adjustment. The first modern cycle begins after World War I, when interest rates had been kept artificially low to finance war spending. Governments had borrowed enormous amounts. Inflation had accelerated, and the post-war question was how to return to normalcy, how to restore the gold standard that had been suspended, how to control inflation without causing depression. And the answer most central banks chose was to raise rates aggressively. The Federal Reserve raised its discount rate from 4% in 1919 to 7% by 1920, the highest level to that point in Fed history, and other central banks did similarly. And as we've discussed, this tight money contributed to the severe but brief 1920 to 21 depression. Rates came down after that crisis, stayed relatively low through the mid-1920s. Then the Fed began tightening again in 1928 and 1929, worried about stock market speculation, concerned that easy money was inflating bubbles, and these higher rates, combined with the commitment to gold, helped trigger the Great Depression, or at least made it much worse than it needed to be. And the crash in rates came not through gradual easing but through crisis, through bank failures and deflation, and eventually abandonment of gold. Rates fell to near zero by the mid-1930s. The Fed funds rate was around 0.5%, where it stayed through World War II. So the first cycle was a rise from wartime lows to restrictive levels in 1920 and again in 1929, then a crash to near zero in the early 1930s. And this crash wasn't a policy choice made in calm conditions. It was forced by catastrophe, by the worst economic crisis in modern history. Rates crashed because the alternative was complete economic collapse. The second cycle begins after World War II. Rates had been kept near zero during the war to facilitate government borrowing, and the question was when and how to normalize. The Fed was initially subordinate to the Treasury, required to support government bond prices, which meant keeping rates low, but inflation accelerated after price controls were lifted, and by the late 1940s there was pressure to allow rates to rise. The Fed Treasury Accord of 1951 freed the Fed from the requirement to support bond prices, allowing rates to rise to market levels. And through the 1950s and 60s rates drifted upward, not dramatically but steadily. The Fed funds rate went from around 1% in the early 1950s to around 5 or 6% by the late 1960s. And then inflation began accelerating, partly from Vietnam War spending, partly from oil shocks, partly from structural changes in the economy. And the Fed under Arthur Burns kept rates too low, allowing inflation to become entrenched. The Fed funds rate stayed below the inflation rate through much of the 1970s, meaning real rates were negative. And this failure to control inflation led to the most extreme monetary tightening in modern history. Paul Volcker took over the Fed in 1979 and raised rates to levels never seen before or since. the Fed funds rate peaked at over 20% in 1981. Volcker deliberately caused a severe recession to break inflation expectations. Unemployment hit 10%. Entire industries were devastated. The developing world faced a debt crisis as dollar interest rates spiked, but inflation was broken, fell from over 13% to around 3% within a few years, and then rates began falling. Gradually through the 1980s and 90s, the Fed funds rate went from 20% in 1981 to around 5 or 6% by the late 1990s, and this decline was managed, wasn't a crash. Was arguably the one example of rates falling in a controlled way rather than through crisis. But that gradual decline ended in 2000 to 2001 when the dot-com bubble burst, and the 9/11 attacks created economic shock, and the Fed, as we've discussed, cut rates aggressively to 1%, kept them there too long, inflated the housing bubble, and when that bubble burst in 2007 to 2008, rates crashed again, this time to zero. The Fed funds rate went from 5.25% in mid-2007 to effectively zero by late 2008, a decline of over 5 percentage points in 18 months, one of the fastest rate crashes in history, and rates stayed at zero for 7 years, until December 2015, and even then the normalization was tentative. Rates only got back to 2.5% before the Fed started cutting again. And then COVID hit, and rates crashed back to zero. And now in 2024, after a brief period of rate increases to fight inflation, we're likely entering another period of declining rates. The pattern repeating, rise followed by crash. And the question is why? Why can't the system maintain stable, moderate rates? Why does it oscillate between extremes? And the answer involves debt, leverage, financial fragility, and the political economy of monetary policy. The fundamental problem is that debt accumulates during low-rate periods and becomes unsustainable when rates rise. When rates are 2%, borrowers can service much more debt than when rates are 6%. So low rates encourage debt accumulation. Businesses borrow to invest or buy back stock. Households borrow to buy homes and cars. Governments borrow to finance deficits. And this debt is sustainable as long as rates stay low. But if rates rise significantly, suddenly the debt becomes expensive to service. Borrowers struggle, some default, and the defaults create stress in the financial system. So there's a ratchet effect where each cycle of low rates allows debt to accumulate to a higher level. And then when rates rise to fight inflation or normalize policy, the accumulated debt makes the economy more fragile, more sensitive to rate increases. And this forces the Fed to either accept a crisis by keeping rates high or cut rates to prevent the crisis. And they almost always choose to cut, because preventing crisis is the Fed's job, and because the political pressure to cut is enormous. So rates crash not gradually but sharply, in response to crisis or threat of crisis. And this is why rates always crash rather than gently declining, because the decline is forced by emergency, not chosen in calm deliberation. The debt accumulation problem is compounded by structural changes in the economy that have occurred over recent decades. The financial sector has grown enormously relative to the real economy. Financial assets relative to GDP have increased from around 4 to 1 in 1980 to over 8 to 1 today. This financialization means that changes in interest rates affect asset prices more than they affect real economic activity. When rates fall, stock and bond prices rise. When rates rise, asset prices fall. And because wealth is increasingly held in financial assets, because pension funds and insurance companies and wealthy individuals all have enormous stakes in asset prices, there's immense pressure on the Fed to keep rates low to support asset prices. This wasn't true in earlier eras when most wealth was in real assets, land and businesses and physical capital. But in a financialized economy, monetary policy is as much about supporting asset prices as about managing inflation and employment, and this creates a bias toward low rates, because high rates cause asset price declines which cause wealth effects which reduce spending which threaten recession. So the Fed is trapped. It can raise rates to fight inflation, but only until asset prices start falling significantly, at which point it must cut to prevent a wealth-driven recession, and this asymmetry. The fact that the Fed will always eventually cut to support asset prices, but won't always raise to deflate bubbles, this creates the pattern where rates crash, but rise gradually. The international dimension reinforces this pattern because the dollar is the global reserve currency. when the Fed raises rates, it doesn't just affect the U.S. economy. It affects everyone who borrowed in dollars. And in recent decades, enormous amounts of debt have been issued in dollars. Emerging market governments and corporations, European and Asian banks, all borrow in dollars because dollar rates are often lower than local currency rates, and because dollars are the currency of international trade. But this creates vulnerability. When the Fed raises rates, these dollar debtors face higher costs. And if their revenues are in local currency, they face currency mismatches. They owe more dollars but earn the same amount of local currency. And if their local currency depreciates against the dollar, which it often does when the Fed raises rates, they're squeezed from both directions. Higher interest costs and unfavorable exchange rates. And this has triggered multiple crises. The Latin American debt crisis of the 1980s, when Volcker's rate increases made dollar debts unsustainable. The Asian financial crisis of 1997 to 98. The emerging market stresses of 2013, when the Fed began discussing tapering QE. Each time the Fed tightens significantly, something breaks internationally, and this creates pressure to reverse course, to cut rates to stabilize global financial conditions. So the Fed isn't just managing the U.S. economy. It's managing global dollar liquidity, and the global system is even more leveraged and fragile than the domestic system, which means the constraints on rate increases are even tighter. The political economy of interest rates also explains the crash pattern. Raising rates is politically painful. It slows growth, increases unemployment, benefits savers at the expense of borrowers, and in a democracy with more borrowers than savers, with more workers than rentiers, tight money is unpopular. Politicians pressure the Fed to keep rates low, to support growth and jobs. The Fed's independence is supposed to insulate it from political pressure, but that independence is granted by Congress and can be threatened, and Fed chairs are aware of this. They know that if they're perceived as causing unnecessary recessions, Congress might limit their independence. So there's a bias toward accommodation, toward keeping rates lower for longer, toward cutting quickly when trouble appears, but raising slowly and reluctantly. This isn't conspiracy or corruption. It's rational response to institutional incentives. But it creates asymmetry in policy. Rates fall faster than they rise. Cuts are larger and quicker than increases. And over time, this asymmetry drives rates downward, each cycle ending at a lower peak than the previous one. The late 1960s peak was around 6%. The early 1980s peak was over 20%. But that was exceptional and deliberately crisis-inducing. The late 1990s peak was around 6% again. The mid-2000s peak was 5.25%. The 2018 to 19 peak was 2.5%, each cycle reaching a lower high. And the lows have gone from around 3% in the 1960s to zero in recent decades. So the entire range of rates has shifted downward over time. And this secular decline in rates isn't primarily driven by real economic factors like productivity growth or demographics, though those matter. It's driven by the accumulation of debt and the political economy of monetary policy that makes sustained high rates impossible. The theory of neutral interest rates, the idea that there's some natural rate that balances saving and investment, that keeps the economy at full employment without inflation, this theory doesn't fit the actual history. Because the actual history shows rates oscillating in response to crises and policy errors rather than converging to some neutral level. The neutral rate, if it exists, is unobservable. It can only be inferred from economic conditions, and different observers infer different rates, and the Fed itself doesn't know what the neutral rate is. It's feeling its way, raising rates until something breaks, then cutting quickly. This is not the behavior of an institution implementing optimal control based on deep understanding of natural rates. It's the behavior of an institution navigating in fog, responding to problems as they emerge, and the problems always seem to emerge on the high side. Rates get to a level where debt service becomes difficult, where asset prices fall too much, where some sector or country faces crisis, and then rates must be cut. This is the crash. Rates don't crash because the neutral rate suddenly fell. They crash because the previous level was unsustainable given accumulated debt and financial fragility. The comparison to the gold standard is instructive. Under gold, interest rates were theoretically determined by the quantity of gold and the demand for it. But in practice, they fluctuated wildly in response to crises. Panics would cause rates to spike as liquidity dried up. Then central banks would intervene or gold would flow in and rates would fall again. The system didn't maintain stable rates. It oscillated between extremes, and this instability was one reason the gold standard was eventually abandoned. But the fiat currency system that replaced it hasn't eliminated the oscillation, hasn't created stable rates, it's just changed the mechanism. Instead of gold flows causing oscillation, it's debt accumulation and policy responses causing it. The pattern remains: long periods of gradually rising or stable rates followed by sudden crashes when something breaks. And this suggests that the instability is inherent to credit-based monetary systems, not specific to gold or fiat currency, because in any credit system, debt accumulates during good times, makes the system fragile, and then when rates rise or growth slows, the fragility becomes crisis, forcing policy reversal. The zero lower bound creates an additional problem in the modern era. When rates are already at zero, the Fed can't cut them further, at least not easily. Negative rates are possible in theory, but have problems in practice. So when rates hit zero, the Fed has to invent new tools: quantitative easing, forward guidance, yield curve control. But these tools have their own problems and limitations. QE inflates asset prices, which increases inequality. Forward guidance loses credibility if the Fed repeatedly fails to deliver on its projections. Yield curve control could lead to unlimited balance sheet expansion. So the zero bound constrains policy in ways that didn't exist in previous eras when rates could always be cut further. And this has led to the strange situation of the last 15 years where rates have been at or near zero for most of the time, where normal monetary policy of adjusting a positive interest rate has been replaced by unconventional policy of asset purchases and forward guidance. And this may be the new normal, because the debt accumulated during decades of declining rates is so large that anything more than minimal positive rates causes problems. The system has become addicted to zero rates, dependent on them for stability, and any attempt to normalize rates, to return to historically normal levels of 4 or 5%, causes something to break. As we saw in 2018 when the Fed's attempt to normalize policy led to market turbulence and had to be abandoned. As we saw in 2022 to 23 when rate increases to fight inflation led to bank failures and stress in commercial real estate. Each time the Fed tries to raise rates significantly, the accumulated debt becomes unsustainable and rates must be cut again. The distributional consequences of this pattern are profound but largely ignored. Low interest rates benefit borrowers at the expense of savers, benefit asset owners at the expense of wage earners, benefit the financial sector at the expense of the real economy. When rates are 1%, someone with $1 million in savings earns only $10,000 a year, barely enough to live on. So retirees and savers are impoverished. Meanwhile, borrowers get cheap money. And because the wealthy can borrow more than the poor, because access to credit is correlated with wealth, low rates increase inequality. The rich can borrow at 2% to buy assets that appreciate at 5%, capturing the spread, while the poor can't access cheap credit, pay high rates on credit cards and payday loans, and don't own assets that appreciate. And over the decades of declining rates, wealth inequality has increased dramatically. The correlation isn't perfect, but it's strong, and this is not coincidental. Low rates drive up asset prices, and asset ownership is highly concentrated. So low rates transfer wealth from people who depend on wage income to people who own financial assets. But this distributional impact is rarely central to monetary policy discussions. The Fed's mandate is price stability and maximum employment, not managing wealth distribution. So the inequality effects of low rates are externalities, acknowledged but not addressed, and politically, the beneficiaries of low rates, borrowers and asset owners, and the financial sector, are more organized and influential than the losers, savers and wage earners. So the political pressure is toward maintaining low rates even if the distributional effects are regressive. The question of whether rates can ever normalize, whether we can return to a world of positive real interest rates and normal monetary policy, is increasingly doubtful because the debt accumulated during the decades of decline is now so large that even modestly higher rates are unsustainable. Total debt to GDP ratios in developed countries are at or near record highs. In the U.S., total debt is over 350% of GDP, government, corporate, and household debt combined. In other developed countries it's similar or higher. And servicing this debt at historical average interest rates of 4 or 5% would consume an enormous share of income, would require either massive deleveraging, mass defaults, or sustained economic growth far above recent rates, none of which seems likely. So we may be stuck in a world of permanently low or zero rates, where monetary policy has lost its traditional power to stimulate or restrain the economy, because rates can't go much lower and can't rise much higher without causing crisis. This is sometimes called the Japan scenario, after Japan's experience since the 1990s of zero rates, deflation, and economic stagnation, and it may be the future for much of the developed world, not because policymakers want it, but because the alternatives are worse. Because the debt accumulated during decades of declining rates has created a structural dependence on low rates that can't be broken without crisis. The hidden history of interest rates reveals that modern monetary policy has been a series of emergency responses rather than steady management of a stable system. Rates haven't found some equilibrium. They've oscillated between extremes, and the oscillations are getting larger and the lows are getting lower. And this pattern of crash-driven policy suggests fundamental instability rather than wise management. We tell ourselves that central banks know what they're doing, that they have models and expertise, that they're optimizing some objective function. But the reality is messy. They're responding to crises often of their own making, raising rates until something breaks, then cutting quickly, and each cycle leaves the system more fragile than before, more leveraged, more dependent on low rates, less able to withstand normalization, and this creates the pattern where rates always crash. Because the crash is always forced by emergency, by something breaking, by the accumulated imbalances of the previous period becoming unsustainable. The crash isn't policy choice made in calm conditions, it's panic response to threatened or actual crisis. And this will likely continue. The next cycle will probably follow the same pattern. Rates will be raised gradually in response to inflation or other concerns. Something will break, a debt crisis or asset price crash or international contagion. And rates will crash again, quickly and dramatically, because that's what always happens. Because the system is designed to oscillate rather than stabilize. Because debt accumulation during low-rate periods makes high rates unsustainable. Because the political economy favors accommodation over restriction. Because the financialized economy can't tolerate the asset price declines that come with higher rates. And because the global dollar system means U.S. rate increases export stress to the rest of the world, creating pressure for reversal. All of these factors combine to ensure that rates always crash, that the pattern repeats, that we're trapped in a cycle of rise and crash rather than finding stable ground. And understanding this pattern, recognizing that it's structural rather than accidental, that it reflects fundamental contradictions in how we manage money and debt and financial systems. This is crucial to making sense of monetary policy history and predicting its future, because the future will likely look like the past, another rise followed by another crash. Another crisis forcing another emergency cut to zero or below, another period of unconventional policy and prolonged low rates, until the next time someone decides we need to normalize and the whole cycle begins again, with predictable results that somehow still surprise policymakers and markets when they arrive, because apparently we never quite learn the lesson that interest rates don't gently adjust to equilibrium. They crash in response to the crises created by previous attempts to raise them, and this pattern, inscribed in the history of monetary policy over the past century, will likely continue as long as we manage money through central banks setting interest rates in economies dominated by debt and financial assets, which is to say, probably forever, or at least until the next fundamental restructuring of how monetary systems work, which may itself be triggered by a crisis caused by attempting to maintain the current system beyond its breaking point, creating the ultimate interest rate crash, the one from which no recovery to previous patterns is possible, forcing the invention of something entirely new. Though what that might be remains to be seen. Assuming we're clever enough to invent it before the system collapse makes invention impossible.